Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Welcome to my podcast. Well, we had quite a week up to Friday. We see the volatility in here. And what's interesting is this. Everyone's saying, well, this market's going to crash, the market's going to crash. We all know that at some point it's going to crash. And I said a week ago, when we had this key reversal and the gold went down and the silver went down and the stocks went down, I said, you got to remember that the trend trackers are saying this is not a key reversal. This is going to turn and go right back up. Because when you have GLD, XLK, UUP, they're the trend trackers. When they don't break all at one time, there's no key reversal. And also key reversal, the first day it reverses, you have that volume. The second day, you got to have the volume bigger than the first day. The third day is the key part to the reversal. And you got to have volume bigger on that third day, larger than the first 2 days. None of those tests have occurred. So there's no confirmation that we've had a reversal. Then you can see what's happened, right? So we talked about that. And to further confuse the market, you get Bank of America coming out, and the jibber jabbers go, oh, look at Bank of America, what they're doing. They're talking about their bull bear indicator. Look at that, isn't it wonderful? The bull bear indicator is telling us that, and they're predicting that we're going to have down the road, some months down the road, we're going to have a crash. But let me explain something. It's not what they're interpreting that wrong. Now, there's only one place you can identify if there's going to be a crash in the stock market. And it's not in a bull-bear indicator. It's not sentiment. Who cares about sentiment? That's all that is sentiment. Sentiment doesn't make markets crash. Financials make markets crash. Sentiment, bad breath, stretched valuations, stretched pricing, everybody's chasing the same stocks. Go on and on and on about the sentiment. Everybody knows the bad sentiment, but that doesn't bring the market down. It will help bring the market down when what is bringing the market down is credit spreads. You know how to identify if a market's going down, and believe me, it's not the sentiment. It's money that brings the market down, not sentiment. So, and also, if you look at the yields, if you look at the credit spreads, if you're looking at right now the 10-year Treasury against the 10-year Treasury against the corporate bond, they're about 120. So if you're now that's on the investment grade. If you're 120 or less, that means that that's good. There's no crash. If you're looking at the high yield spread, that's 300 and under. Same thing. So 300 and under with a high yield spread, under 120 with investment grade. They're all showing there's no market crash coming. Now, when it does occur, you'll know right away. When a market crashes, it means that we have gone over that threshold of 120 and over that threshold of 300. And you know immediately. The Bank of America, okay, their bull bear indicator is sentiment, and that doesn't go first. That lags behind. So everything we're seeing right now is telling us that this market crash that we had, first of all, was not a key reversal. Now that can change. Markets always do what they're supposed to do, but never were supposed to do it. We know that. Now that could change in the next couple of days. We don't know. But we know everybody, all the jibber jabbers. Oh, this is the key reversal. This is the key. This is the crash. This is it. It's over. And then look what happened. Boom, turned around, went right back up because what? The first thing you could look at is that the three trackers who track trend didn't perform in a way that it shows a key reversal. When you have GDX, XLK, and the dollar UUP, they have to break at one time. It never happened. And nobody wanted to hear about it. It never happened. It never happened. So now, every major crash that we've had in the last 40 years has nothing to do with sentiment. Every major crash we've had over the 40 years, it was the spreads. It's when you get wide spreads over that 120, over that 300, you're going to have a crash, and it happens immediately. Now, back up a little bit where you have the Bank of America, the bull-bear indicator, that just lays another layer on top of it. The bear-bull indicator can't crash markets. Sentiment don't crash markets, financials. So when you keep hearing about this Bank of America bear-bull indicator, they're full of crap. It doesn't work that way. Now, yes, they'll come along, and if the fundamentals are bad, they'll just do a piling on. So that's what's going on right now. And the credit spreads move very fast, and they move first. And therefore, you got the Bank of America bull-bear indicator dragging behind. See how that works? So the credit market moves always first. So that's what's going on with that, okay? So there's no, as far as a crash, everyone thinks now it could happen because we know how markets are. You got to be prepared. You want to know how to sell short. But for now, the pattern that we're seeing, there's no indication of a crash right now. So, but that could change. We understand that. So that's what's going on there. And again, we're back to the market where everyone's talking about the labor market. And the labor market is not a good market. It's weak. The labor market's very weak, and it's going to get weaker. And AI causes the market to get weaker. And then you got the labor market to get weak. And then you have the jibber jabbers, right, on there listening to this garbage.
I think the underlying economy, the data has been relatively healthy, and so that's definitely a big help. This earnings season so far, there's still a lot to go, but the earnings results have been pretty healthy.
It's not earnings result. Earnings result doesn't move stocks. It doesn't. It's their expectation that moves a stock. They can miss their earnings totally, but it's the expectations is what moves stocks. I mean, it's unbelievable how they just lie about that. Now, gold, people are asking, why isn't gold going up? Well, let's go to our charts. Now, I'm talking about the gold stocks. So if you look at what's really, where we've made some good money, is on the small banks, USB, okay, Truist Bank. I mean, these have just been real monster moves, okay? And of course, if you go down to our gold stocks, I mean, they've been unbelievable until we had this correction. But right now, if you look at GLD, that price is gold, and you're seeing gold's going back up. Don't get caught. If you're in there right now, if you're jumping in on GLD, or you're jumping in on the miner, GDX, and you're buying on this dip, you're going to get crushed. And you're buying Barrick Gold, and you're buying Newmont, and you're buying Posh. All these are in a downtrend. They're going the wrong way. These are called snapbacks. Until you get more buying volume coming in that turn your buy signal around, which right now you have a sell signal on your stochastic, not a buy signal. So everybody's jumping in thinking, oh boy, I'm going to buy on the dip. You're going to get crushed because it's going to come back down. So if you're buying, for example, GDX today, and you're buying it at $162, we'll say, you're going to be taking out that low very, very soon of $92.28 because the trend's telling you that. Trend is your friend. And look at the volume. If you go back 10 days, you got more sellers on the way down than buyers now on the way up. So just don't listen to the jibber jabbers telling you how wonderful everything is, okay? And that's exactly what they're doing. I mean, when you hear this nonsense from these people, right?
You know, I think the underlying economy, the data has been relatively healthy.
No, it hasn't been healthy. Data hasn't been healthy. What are you talking about?
We are growing above trend. The consumer is consuming. Manufacturing actually is picking up. We got a Chicago.
No, the consumer's not consuming. The consumer is still in debt. If he can use his credit card, he's consuming. That's the only way he can consume, using his credit card. And as long as the credit spreads are tight instead of widening, then the banks will continue to, have confidence and keep loaning, and that's what's going on now. They want the consumer to get deeper and deeper and deeper in debt. And that's why you watch the credit spreads, because as long as the credit spreads are tight or below, like I said, 120 or 300, whatever one you're looking at, as long as they're tight, they're going to keep on lending to these people. So this is not good news, okay? And as far as gold goes, you got to make sure. Let's go to our gold stocks here for a second again. Your gold, for gold to go back up and be stable, you got to make sure your gold price, okay? Your gold price is on your gold yields, the yields on a 10-year treasury have to be below, okay, again, about 380. If they get below, the 10-year treasury drops below 3.8 out, gold begins to rally. If you're staying at 4 to 4.1, it stabilizes. It's not going to go up, not going to go down. So, and your gold, okay, will start surging once your 10-year treasury yield gets to 370. So my point is, there's all these little things you got to know. Stop listening to the jibber jabbers. They know nothing. Oh, they do, but they're always full of optimism. They sell you optimism. So right now, be careful with your gold. Don't be in there chasing it when you got yields that are nowhere near, okay, 3.8%, or you're going to get trapped. So, let's see, we had, where's the other? Okay, yeah, oil. Let's talk about, let's go back to the charts. So, now, if you look at the small banks, okay, they're the ones, the small banks, we've stayed in these small banks, and we're doing really, really great in these small banks. And so I told my gang members, I mean, just take a look, my God, look what we did with Truist, TFC. That thing just took off. PNC taking off for us. Key Bank is taking off for us. These are like shooting fish in a barrel. MTV, while everybody else was jumping into tech and getting crushed. So I would stay with my small banks, the regional banks. Stay away from your big banks. Now, people are jumping in J.P. Morgan right now. They're jumping in Citi, and they're jumping in, Goldman Sachs. But the uptrend is not confirmed yet. The uptrend's not confirmed yet. It could come right back down. You got to wait to like for example, when you're buying these banks, you got to let them go back to the most recent high. Like if you're trading, for example, Wells Fargo, and the recent high is somewhere near 96. Okay, you can't buy it until it gets back above 96. That's where you buy it, because you don't want to be buying based on it's going up because people are covering their shorts. You want once you get that new high behind you, you got new institutional money coming in. So that's what's going on right now. So everybody's got things screwed up. They really do. Because Wall Street does that on purpose. I mean, it tells you everything is optimism. Everything's great, everything wonderful. So underneath, they're moving around, protecting themselves. They're dumping this, dumping that. So again, it always comes back to follow the money, know how to sell short, know how to go long, know how to hedge your 401ks. You'll be just fine. And come to us. We'll show you how to do it.